Hi, everybody. My name is Matt Smith, as you can see up there. I'm a CPA and also a CFE, which is a Certified Fraud Examiner. This is my third year of speaking to this organization, so I appreciate the opportunity to get in front of you guys again. I work for a CPA firm called Dean Dorton, and we're based here in Lexington. We have an office in Raleigh, North Carolina, and also in Louisville as well. I have been, well, first off, can anybody, what do you think accounting is? Anybody?
Management of finances?
Yeah. So my role and what I've done over the last 15 years now is helping business owners, dentists and physicians in particular, make sense of the dollars coming in to their practice and going out the door so that they can make good decisions about running their practice. Ideally, helping them to save taxes and lower their overhead so that more of the dollars that come in their practice go into their pocket. Let's see, what else? So I live in Berea. I am been doing this for probably 20 years. I'm graduated at EKU. I've got 3 kids, and this weather is driving me and in particular my wife crazy with everybody stuck at home, so I'm glad to get out this evening. Yeah, so I don't know if you all can see that or not. I will try to make this exciting. It is accounting. It is kind of the blocking and tackling of making money. You've got to keep track of your numbers so that you can make good decisions. So what I want to do today is give you an example of how money flows into a dental practice out to everybody else except for the owner, and then whatever's left you all get to pocket. And another thing that I want to help show you all is that being a good dentist does not mean you're a good business owner. They're 2 completely separate things. And you see that, I see that time and time again, that having really good clinical skills does not translate to running your business well. And if you don't want to be super hands-on with the running of the business side, then it's important to surround yourself with folks that can handle that for you. And please ask questions. I do this day in and day out, so I'm going to probably go pretty quick, but if you have questions, please stop me. I'm happy to help. There's no question that I can't give you my 2 cents on. And so how I'm going to do those objectives would be, we're going to go through and give a typical structure of how a dental practice gets off the ground, go over an income statement, or also known as a profit and loss statement, and then discuss a couple key observations. And the examples that I've got in here are just examples. They're not real benchmarks for a practice to shoot for. And in fact, this practice, their overhead is significantly higher than what you should be shooting for. So this is not a target for you to shoot for. And if you can't see this well, I'm assuming, Ryan, that you could share the presentation with everybody. Okay, so typical setup of a new dental practice. Do most of you all have plans to own a practice of your own at some point? Otherwise, this is probably the purpose of this organization. So the 2 main ways are you go and you buy someone else's practice and you inherit the good and the bad from that, or you start a practice from scratch, which has its positives and negatives as well. This, I wonder if this has a laser on it. Probably not. But if you're purchasing an existing practice, these are the questions. This is the largest question that you need to ask yourself, and it's a multi-part question, but you need to be looking at what that existing practice is doing from a cash flow standpoint. And you want to take that information and modify it for the changes that would happen if you are going to be the owner instead of the existing owner, and then run all those numbers through to see if it accomplishes all of these things. Will that practice have enough cash flow to pay all the overhead costs every month, to cover the loan payment, because unless you have are financially independent, you're probably going to be borrowing for 100% plus for this acquisition. Will the cash flow cover the equipment needs and then what you need to live on as well, plus have a little bit of a cushion? And if it doesn't, for what that asking price is, then that's probably a practice that, unless there's some hidden thing in there that you'll be able to do something drastically different than what's happening historically, that's probably the price is a little bit strong, or you need to keep looking. The non-financial things that go into this would include, there will be patient attrition when a practice changes hands. There will be patients that use as an opportunity to go elsewhere. So that's a negative impact for you all. But one of the positive things is I've seen that a lot of the older practice owners, as they're getting towards retirement, they refer out a lot of stuff that they don't want to necessarily deal with anymore. And so you might be stepping into a practice that it has a whole bunch of work that could be done, or that the previous dentist has been outsourcing or referring out, that you could be capturing. And so that practice that is generating X number of dollars for that dentist, when you step in and you start doing all that additional work, it could be a multiple of that. So that would be a positive change for you. And then for startup from scratch, which are not nearly as common as buying someone else's practice, there's no way that the cash flow is going to support that. So when you're borrowing funds, you need to make sure that you have some capital that will help you and the practice get through that couple months period where you're building up your patient base and getting to a point where it's at a break even. So you definitely, if you're looking at a practice to acquire or even starting from scratch, you want to be trying to build some model or some projection of what that practice is going to be doing so that you can make a good decision about that. Because odds are that selling dentists may not, well, if they ran the practice well, they probably don't have a huge loan that they're having to pay, but you will. They don't have student loan debt, but you will. And so there's a lot of different factors that will go into this decision, and you want to have as much information as possible. So when I help practices or young dentists look at this, we get historical information from that existing practice, have discussions about how that information needs to be modified for some assumptions for the new dental practice owner, and flush it out and see, oh yeah, there's money left over every month if this happens, or oh, you're shy $3 or $4 grand every month, so maybe the asking price is too high, and if it was lower, you could make it work. And that's, I'm not in the business of saying that the price is high or low. You know, that's a practice broker, and they deal with all that. But I can help a dentist with, if this is the price that they're asking, and you've got to go borrow funds at this interest rate, and we apply all these factors to it, this is what would drop to the bottom line. Yeah.
As far as when you do buy an existing practice, let's just say production's at $1 million. What is it typically for a new grad, either a year or 2 out, of what's required? I'll change it on my computer.
Okay.
Of what is expected as, okay, yeah, this is probably the production level you can do.
So, sorry, I got distracted by that thing going off. So $1 million of production.
Yeah, I mean, you're buying something that says $1 million, but obviously you probably can't produce $1 million like this dentist. So what is it typically that you see when new grads come out, or even a year out, of what type of level of production they're able to do?
I have not really seen a major dip.
Really?
Yeah. I'd say at most, you might see like a 10 or 15% reduction in that initial year. But like I said before, sometimes you all will produce more. You're hungrier for it. So you might not be as fast at it, but you might be willing to work longer hours or do those procedures that the retiring dentist didn't want to do anymore. So it is kind of a shotgun pattern of some will do 1.2 on that $1 million of production, and some will do 800,000. So it's all a matter of what are the procedures that they're doing that you cannot do, and you'd have to back those out. Or on the flip side, if you're trained to do implants and they're not doing them, I mean, that could add to your production, that kind of thing. I hit forward too many times trying to get it fired back up again. All right. So profit and loss statement or income statement. This is one of the main financial reports of any business that shows the dollars coming in the door and the dollars going out the door. You can run it for any given time period. So ideally, if you own a practice, you get set up with some type of accounting software that's helping you to record the dollars coming into the practice bank account and the dollars going out of the practice bank account. And you're dumping all those transactions into different accounts that generate this profit and loss statement. So you can see how you're doing. You can see how much you're spending on these different expense categories. And you can take your numbers and compare them to peers and benchmarks to see if you're paying your staff too much or your lab costs are too high, all those kinds of analysis. So, and that software, you can run your reports for a year, compare it to the prior year to see if you're growing or not. I mean, it should be able to slice and dice the data however you want to see it. Yes?
Is there a program that you recommend?
For most practices, that's a 1 or 2 or 3 owner practice, maybe 1 location, maybe 2 or 3. The one that most businesses use is QuickBooks. There's an online version of it, so it's web-based. Over the last 10 years, their pricing has gone up substantially, but it's still, I'd say 99% of small businesses use QuickBooks. There are some alternatives out there as well. But QuickBooks will do what you need because a dentist is not using QuickBooks to track how much their patients are owing them. They're not using QuickBooks for payroll. They're outsourcing that. And so you're really using QuickBooks as a check register and the ability to generate reports at a high level. And its reporting metrics are pretty good for a business of that size. If you start talking about 10, 15 doc practice, multiple locations where you're really needing to analyze data on a more fine detail, there are bigger and better software programs out there to do that. So yeah, income for a typical dental practice is patient fees, your expenses, your overhead, and costs you're paying to other providers, and then what's left over is your net income. Typically, we try to break down a dental practice's expenses into these categories. Those then give us the ability to benchmark those larger group amounts against industry standards. So like under staffing costs, for example, that we'd have a separate expense account for the actual gross wage amount that you're paying to your staff, but then we would also have a separate expense account for the payroll taxes that the employer pays, plus if you're paying health insurance or any other employee benefits, and then it would total up all those individual line items into one subtotal for the staffing costs, so you can kind of see, oh, I'm spending 25% of my revenue on staffing costs. Whether that's good or bad just depends on your individual situation. What is not on the profit and loss is these couple items here. So principal payments on the loan. So when you borrow funds, that money comes in the door, that's not income. So when that money leaves to repay the loan, that's not an expense either. It's a balance sheet item. It's not on the profit and loss. The interest that you pay on the loan is an expense and will show up on your profit and loss. So if you borrow, $500,000 and you repay it over 10 years at 4 or 5%, you're going to end up repaying, $600,000. Well, that $200,000 of interest. I am good at math. I just have a bad memory, so I can't remember if those numbers match up or not. But that interest will be an expense deduction on your profit and loss each year as you're paying it. Other things that are cash out the door of the practice that do not show up on the P&L would be acquiring fixed assets. So fixed assets are pieces of equipment that you use that have a life of longer than a year. I think my next slide gets into that. But the way that you expense that is those items are depreciated over time. And so if you buy a piece of equipment that's going to last you for 5 years, you have the ability to deduct that cost over that 5-year period. Now the IRS rules to encourage growth and whatnot, they allow you to expense a lot of the equipment in the year that you buy it, and that's something that you would want to look at with your accountant to see whether it makes sense to do that or not. And then distributions of the profit to you are not an expense. You don't get to deduct that from the practice either. So yeah, here's just an example of depreciation, or a definition of kind of what it is, and then a couple examples. So the dental equipment that you're buying, the lasers and all that good stuff, has a 5-year life. And what that means, if you choose not to use these accelerated depreciation methods, the cost of that, $50,000 pan machine, you would write off a chunk of that each year over the 5-year period. So if you borrowed for it, when you borrowed the 50 grand for that, you would have a $50,000 asset and $50,000 debt. Both of those are on the balance sheet. As you're paying the debt off, the cash out the door to pay the loan off is not an expense, but the depreciation is. So you can kind of think about it as depreciation is writing off that equipment as you're paying it off. So the next couple slides, I am showing, we've came up with this goal for the practice, and then what happens if the practice doesn't meet the goal versus if it does meet the goal. And so the production goal on this particular example is $100,000 for a month. That's what we shoot for, and after all the insurance write-offs and other denials or whatnot, we're anticipating that we're going to collect $80,000 on that. In the under goal, the practice only produced $87,000 for the month, and so $69,000 came in the door, and then on the overproduced, they did $10,475 more, and so $86,000 came in the door. And what I want to show is how that really, the bulk of that either positively or negatively impacts you, not so much the practice. So this is a profit and loss statement example where the top line there is your collections that came in the door, and these amounts came forward from the previous slide, where if you made goal, you had all these different overhead expenses of $54,500, and then you're paying your hygienist $8,000, so there's $17,500 left over before the owner takes any money out of the practice. In this hypothetical scenario, the owner's taking a $12,000 salary each month, so the cost with payroll taxes and insurance and everything in this example is $13,000, so there's $4,500 left. They're paying $4,000 a month on the principal, and so the goal, they're adding $500 a month to their practice bank account if they're making goal or making what they've budgeted to happen. So the thing about a dental practice overhead is a lot of those line items are fixed, meaning your rent stays at $5,000 whether you produce or collect $90,000 or collect $60,000. So, the more you produce, the greater the gross profit is and the more is available for you. You have some variable expenses like the dental supplies and dental lab, based on the amount of procedures you're doing, those go up and down. But even a lot of your staff, they might be paid the same amount regardless of how much you produce, if they're hourly or on salary. So this is trying to display that for this particular month, if the practice only collected $69,000 and it's kind of set up and on track to be doing $80,000, well, that particular month they ate up almost $6,000 of cash that was in the bank account at the beginning of the month. And then on the flip side, if they did $6,000 more than what they had anticipated, well, they've added almost $4,000 of that fell to the bottom line for the owner to either take out as distribution, to buy equipment, pay themselves more, whatever. But if you're not tracking what it takes to run the practice, you have no idea whether you're doing better or worse than what you had wanted to do, and making decisions is very hard to do if you don't have this information. Any questions on the P&L? I mean, this is just kind of a generic. Ideally, this net income before owner of 22%, that's really low. Good practices that I work with, well, I have some outliers, but some of them are taking home 45 cents on the dollar. Some of them are in the mid to upper 20%. Most are probably in the mid 30s, somewhere in that range. So for every dollar a collection that comes in the door, there's 35 cents left over for the dentist.
Can you speak to the overhead a little bit, as far as like typical overhead benchmarks and how much it actually changed when you overachieve on your goals?
Sure. So I'll just kind of go down through each line item. I mean, so staffing typically is fixed.
68% usually, from what I hear, is actually pretty high.
Yes, it is. Yeah, that's
Usually like 50-ish is really good.
that's really good.
55,
Yeah,
60.
yeah. So the inverse of what I was saying about gross profit is what the overhead percentage would be. So someone that's profiting 35%, their overhead's 65. That's probably about what I see. The really good ones, they can achieve the 50-50 split, but that's rare. A lot of practices are overstaffed and yeah, and not leveraging well, not using hygienists properly, and things like that.
Where do you see people typically adjusting in these fixed and variables to get their overhead down the most?
I really encourage the practice owners to figure out ways to grow that top line more so than the overhead, because once you get set in your ways or you've got the staff that you want, I mean, a lot of those numbers are just going to sit there year after year. And so if you can use that, you know, your rent's going to stay the same for a period of years. If you have an office manager and, you know, another front desk person and 3 assistants and 2 hygienists, that cost is going to stay where it is. So if you can be figuring out ways to, you know, increase your patient base to refer out, be doing more procedures, having your staff do more so that you can focus on the clinical side, that's really where I spend a lot more of my time than chasing after the lowest cost for this particular thing. Because once you're good with your supplies or the labs that you like to use, I mean, those costs are just going to be what they are.
That's kind of the conundrum that we face all the time. A lot of offices will chase to the bottom line, and they get so worried and so fixated on how these fall out sometimes that they forget that if they spent that time just producing instead of worrying about saving 20 cents on something, then the growth is much greater than what they're going to save on the bottom line.
Yeah. Yeah.
But a lot of those are about, like, the supplies are a little high, your lab you can play with depending on where you are in technology. Some of those things you can play with percentages a little bit, but they're always the ones on the lower end of the scale, so you're not going to have that much of an influence on the dollars.
Yeah. I probably should have made the overhead really low to make it look like you all are going to make tons of money and want to go into private practice more. But for whatever reason, yeah, those costs are high. You know, your supplies and labs should definitely be under way under 10% of your collections. Yes.
So you're saying 35 cents a dollar the dentist is making or bringing the practice in. What percentage is the actual dentist taking home on average from that 35?
Well, so the next slide kind of gets into the taxes that come out from that and all the others. So I'll get there, and then if you still have more questions, we can talk about that more. Yep.
How does that change if you own the building that you're?
Yeah, so typically, newer dental practice owners are not acquiring the real estate right out of the gate. They can, but I don't know if it's they don't want to bite off more than they can chew, or the lender won't also lend for that, or what. But the rent that you'd pay, that's going to really, I would encourage if you're going to buy the real estate, you buy it in another entity, not the dental practice entity. And then you set up a lease between your dental practice entity and your real estate venture, and you pay rent to that entity, and that entity takes the rent and pays the mortgage And then, you're building equity in that off to the side. It doesn't necessarily change the overhead because you still have the facility cost there. You have some control over it, but most will end up paying a somewhat fair market value for what that rent would be. But I have practices that pay $1,200 a month in rent and generate $900,000 in collections, and I also have practices that pay $7,000 a month in rent and don't even generate that much. So it's all about where you are, how big a space you want. So it's not so much about whether you buy it or not, but about the square footage, and if you're in a small town or right, in a shopping center, those are things that you'd want to think about. Yeah.
You were talking earlier about how you see different approaches from dentists. Some are really hands-on, really knowledgeable about all of these financials, and others surround themselves with a really great team, and they're less involved. And like was stated earlier, sometimes being too hands-on or you can waste time from what you could just be doing in production. Do you find like one approach to be superior to the other as far as the success of those dentists?
I would say the dentists that come across to me as more interested in, making sure that they're recording things right in their records and everything are the more successful ones, versus the person that I'm dealing with their office manager more than them. And they've outsourced a lot, and there's risk involved with a lot of that too, as far as on the fraud side of things. So, in general, having somewhat of a hands-on approach to at least knowing where your dollars are coming in and out seems to lend itself to making better decisions and being more profitable.
Love everyone, but trust no one.
Yes. Okay, so staffing is typically going to be fixed. That's probably not too far off, 20% from what you'd be shooting for. Facility costs obviously will be fixed, your utilities and rent and everything. That's probably high. Advertising, that's up to you. How much do you want to spend on marketing to your existing patients, to potential new patients? Technology is going to be, your website, your computers and all the maintenance that go into that, your texting reminder stuff, software for patients to make sure they're coming to your appointments, and you all know what supplies and labs are. And then office and admin is where you'd pay your professionals, your office supplies, subscriptions, your annual dues, all that kind of stuff, insurance, and so. Really, the only things that are completely variable are the supplies in the lab. What you're paying, most of the other stuff is going to be fixed. And a lot of times, at the end of the year, we'll sit down and do a budget for the year for a particular practice. And when we get to the end of the year, what they actually spent expense-wise, like down here, the $54,500 for the whole year, over the whole year, it'll be off by less than like $3,000 or $4,000 from what we had anticipated. It doesn't happen all the time, but sometimes it does. And so we can get pretty good at figuring out what we think the cost will be, and it's all up to what they actually produce. And then, with COVID, and there's all this other stuff that's factored into the last 2 years that have really swung things one way or the other. But that's why when you're looking at a practice that you're acquiring or starting from scratch, you need to really spend a lot of time trying to model and predict, what the most likely outcome is for the dollars that could come in the door.
Not to go down a rabbit hole with COVID, but what would you say are the main things that you've seen practices have to deal with in regards to either keeping their goals and hitting their goals in the midst of kind of a different environment?
Sure. It's been kind of it's going to sound weird, and maybe you guys have talked to people that own practices or businesses, but some practices from a financial standpoint have actually done better over the last 2 years than in their last, say, 3 or 4. From a exhaustion, psychological, wear and tear standpoint, everyone is exhausted and tired. at first, back in March of 2020, our governor shut down, medical procedures other than for emergencies. And so for about a month and a half, practices couldn't be or shouldn't have been seeing patients except for emergencies. And so you can imagine if you're going along needing $80,000 a month to live on, well, there's $120,000, or to make the practice go, there's $120,000 that didn't come in for that month and a half. What I did see happen, though, was when you could reopen, a lot of practices had patients come, and just those visits all got crammed into that period when it got opened back up. So they had like really good Mays and Junes and Julys. And the aid that our federal government sent out to business owners, the way that those programs were structured, you could get loans that were forgiven if you spent the money on payroll costs. So if you kept your employees on the payroll, that money would not have to be repaid. And so that's income, and it was tax-free income. So it's really worth about 40% more than getting that money in patient fees, because if it's patient fees, it's taxable, and you got to pay taxes on the profit. So that program was really beneficial, and there were two waves of that. One in mid-2020, and then a second round of Paycheck Protection Plan loans came in early 2021. And so they had a drop in their patient collections for the year, but when you threw that PPP money in, they actually ended up having more revenue, and their expenses were relatively flat, or even down. Some did furlough some of their staff, that kind of thing. A lot of, I'd say, manufacturers of those HEPA filter devices probably made a killing, because a lot of practices would buy 8 or 9 of them and put one in each room, and that's to mitigate the risk. And but again, there was more government aid out there for healthcare providers, where they could document their lost revenue or their additional costs that they incurred to stay open. So any of the plexiglass shields and masks and thermometers and those HEPA filter devices, and they could document that, and there was specific money for healthcare providers that HHS gave out as well. And then there's even more aid that I won't bore you with all the acronyms on, but most practices, if they were on the ball about taking advantage of those programs, did okay. Yeah, no one that I worked with went out of business or anything like that. Okay, so in this example here, we're just going to say that the $500 is just to bank to go towards buying equipment in the future. And so that $13,000, the owner costs the salary of $12,000, that's coming over here. And a practice is either set up such that it is a corporation and the owner is paying themselves a salary. And the salary is wages, and the owner will get a W-2 from their practice, and taxes will come out of that, and they'll get a net check just like any other job. In this hypothetical, federal taxes assuming 25%. Kentucky does have a flat income tax rate of 5%. Social Security and Medicare taxes are fixed at what they are. And then in Lexington, you pay 2.75% local tax. So on that $12,000, you got $7,100 left over. And then in this example, the student is paying $2,500 a month on their former student is paying $2,500 a month on their student loan. So they got $4,600 take-home pay to really live on. And so just reiterating back to you need to be generating that $100,000 so that in production, in this hypothetical example, so that you can continue to be paid that and the practice is still going in the right direction. If you're not set up as a corporation, then the profit of the business, all of it is distributed to the owner, and then the owner has to pay estimated taxes instead of having the taxes withheld. So it would be up to you to pull the $12,000 out of the practice and set some of that aside so that you're paying in these estimated taxes each quarter, so that when you go to file your tax return, you don't owe, $70,000 and you don't have any of it set aside. So that's where tax planning is really important, so you don't have any huge surprises. So in this example here of achieving better than budget, there's an extra $4,000 there that the owner could take out. And as a general rule of thumb, if you just say 40% for taxes, that's what you would truly get from the income that the practice generates. That's kind of a good ballpark or a rule of thumb, but you would want to work with somebody on your particular situation to know, how much to be setting aside, because you might have some other activity going on that really helps you offset some of the dental practice income, or you might have a spouse that's also pulling down, $200,000 or $300,000 a year, and then the taxes on this will be higher than someone that doesn't have a spouse that works. All the yeah, go ahead.
I was just wondering what variables, you're talking like LLC versus S Corp, like what variables are you looking at? Like, let's say you're in a location and your production's higher than other surrounding dentists, because I know how it works with the S Corp. It's like you dictate what a reasonable salary would be that the IRS would deem reasonable. So say your production is 20% higher than those around you, would that prompt you to go with an S Corp versus an LLC?
That's a really good question, and let me get into that, but I'm going to take one step back further to just talk about them both together, and then I'll get into that. So whether it's an S Corp or not, almost every practice nowadays forms as an LLC or an S Corp, and they're what's called a flow-through entity, which means the profit and the tax consequences of the business flows through to the individual owner, and the individual owner bears the tax cost as part of their personal tax return. And so an S Corp return, let's say that you collect $1 million, your overhead's $700,000, so there's $300,000 left for the owner. Let's say they pay themselves $120, and the other $180 is profit that they would distribute out to themselves. The $120 on their individual tax return comes through as a W-2, and they pay taxes on that $120. The S Corp would give them a K-1 that's another tax form that shows that the practice had $180,000 of profit. That $180 would be tacked onto your wage of $120, and your individual return would show all $300,000 of income, and you'd have to worry about paying taxes on all $300,000. If you're not an S Corp, basically there's no wages, and all the $300 profit just goes through, and you have to worry about the $300. It ends up in the same point on your individual return. It passes through, and so you need to be thinking about how much in taxes do I need to be setting aside, and which route is the smartest route to go. So that's, if you hear pass-through entity, that's what that means, is the income. It's not like Walmart or Apple where the entity files its tax return and pays its taxes on its share of profit, and then it sends dividends out to the shareholders. It's the entity files a tax return, but there's no tax due at the entity level. It all flows down to the individual owner, and then they handle the tax consequences. Now, on the S Corp route, there's a whole lot of things to talk about on that. It really depends on a lot of facts and circumstances of your particular situation, because there are tax deductions out there. There's one, the main one that influences decision a lot is called the Qualified Business Income Deduction, or QBI deduction. And it allows certain small businesses to not have to pay taxes on up to 20% of the business's profit. You still show all the profit, but then you get a deduction that calculates at 20% of that comes off of your taxable income. That's been maybe 3 or 4 or 5. Within the last couple years, that deduction came into the tax world. And so that, if you're eligible for that, it phases out once you make so much money. So if you're going to be making, $500,000 or $600,000, then it doesn't matter because you can't get that deduction. But if you're going to be making $200,000 or $300,000, then you could potentially get that full deduction. And it's calculated on the net income of the business, and your wage is not considered net income. So back to my example of the $300,000 in net income that's left over. If you're an S corp and you paid yourself the $120 of wages, you only get a 20% deduction on the $180,000. If you didn't be an S corp and you just filed on Schedule C, you could get a 20% deduction on all $300,000. And so that's a positive change to say don't go S corp route. But that doesn't work in all scenarios. And so you would want to run analysis both ways before you made a decision. And you don't have to go S corp from day one. You can go a few years as filing on Schedule C and then say, on this year I want to switch over. You file a form and elect it, and then you are an S corp from that point going forward. The other piece that you talked about was a reasonable wage, and that's really a gray area. I would say, what would you have to pay a dentist to step into your shoes and perform the dental services of that, of what you do? And if you could document that $150 is a reasonable salary, even though you're profiting way more than that, I think you would have something to hang your hat on if the IRS ever came knocking. I don't necessarily know if it makes sense to get into the pros and cons of paying yourself a lower wage. There's, aside from the income tax, it's this piece right here, the Social Security and Medicare tax. The profit of an S corporation is not subject to those taxes, but wages and profit of a Schedule C are subject to those taxes. So that's a positive of going S corp, is if I can get some of my money out of my business without it being subject to some of those additional taxes, I'm going to do that. And so, you have some S corps that pay their owners nothing, that's just waiting for the IRS to come and say, hey, you're not paying yourself a reasonable wage, and they can go back and recharacterize what you've paid as distributions, as wages, and you got back payroll taxes and penalties and interest. So you would really want to pay yourself enough that you could, document or justify it as a reasonable wage, but on the low end of that is what you'd be shooting for, so that the bigger chunk of your income could come out without being subject to those taxes. This is all at a real high level. Is there any questions on that? It's a lot of complex analysis that goes into those decisions. So a couple key observations, just hopefully that you can take away from this, is that setting realistic goals is really the foundation of knowing whether you're doing well or not. If you're not measuring any of it, if you're just going by, I got enough money in my bank account to pay payroll this week, there's no way that you could be making good long-term decisions about you and the practice. A lot of the expenses are fixed. We've already talked about that to some degree. And if you can find ways to generate more revenue, your overhead's going to stay the same for the most part. So a big chunk of that. So if we step back to saying 35 cents of every dollar comes into the practice, ends up with you, well, if you are able to generate one more dollar, if the only expenses, if your only overhead that's variable are supplies and lab, and that's only 20%, let's just say it's 20% of your collections is in those, well, that means 80 cents of that additional dollar is going to your pocket, not just 35, because all your collections that you had to cover all your fixed costs get you to that 35% range. So the more you can generate revenue above what it takes to run the practice and keep it going, the greater your gross profit percentage will be for you. So every employee's position at the practice is really crucial to meeting the financial goals. And this is where you asked earlier about the struggles of practices, and they didn't really necessarily struggle financially, but one area where they really did struggle was keeping staff, keeping hygienists, keeping front office people at work. You see in the news every month that 4 million people quit their jobs each month for the last 2 or 3 months. Well, that's not dentists and dental practices haven't been isolated from that. I mean, they've experienced that as well. So if you can find a practice or form a practice that has a really good cohesive team that all works towards the same goals, that's worth way more than saving a couple dollars on some of your overhead.
What would you say is driving that unemployment, like just not working?
It's, this is just me in my brain, which you can take that for what it's worth. It seems like a lot of the people quitting their jobs are in public-facing jobs, and I think they're just really burnt out, and people are rude, and some employees don't want to be exposed to the risk of the virus, and a lot of people aren't happy with their hourly wage, and they're seeing some of their friends and coworkers being able to work remotely, and a lot of their employees a lot of their employers are saying, no, you need to come back to the office. And so they're like, well, I kind of liked working from home. I might find a job that allows me to do that. And I mean, if you're a front desk clerk or a dental assistant, you can't do that job from home. So some of them, I think, are contemplating career changes so that they're, I think they're making long-term decisions based on a short-term thing, but that's what the employees are doing.
We saw a lot of older hygienists leave the field, older assistants, just the stress and the anxiety of dealing with the changes through COVID, on top of their age, and maybe they were a little more susceptible, they just gave up. It was just too hard to deal with it, and they gave up. Some of the schools shut down. The cost of running some of those schools is huge. So a lot of your hygiene schools don't have as many students going into them right now. But we are in desperate need, especially around here. We're really, really short of hygienists and
Yep.
assistants in a lot of offices. Everybody's looking to hire.
Yep, you're seeing a lot of hiring bonuses out there and retention bonuses out there that you've never seen before, just to keep staff or to steal staff away from other practices out there. Because if your collections is dependent on your hygienist being there, and $15,000 per month of that collections is your hygienist, and they leave, I mean, you don't have room for a $15,000 drop. I mean, the hygienist's wage might be what, $4,000, $5,000 of that $15,000 of collections. So you're net losing $10,000 a month for that.
Not to mention what they're feeding into your own
Yeah.
personal production.
Yeah.
And you can never undersell the value of culture, as we talked about many times in this series. If the culture is substandard or even normal, and they can make a little bit more and practice down the street, which, by the way, is being offered because they can do that maintenance, you're at risk of losing those employees. And we've seen a tremendous amount of jumping from one practice to another, which, by the way, creates a lot of bad blood between your competitive dentists downstream, too. So culture is key. When we see great cultures in dental practices, they don't leave because they still like coming to work. That's not the case. They're going to jump ship all day long for a little bit more money, which we know only motivates for a very short time.
Yeah, and in that regard, another project that I help a lot with is coming up with systems to compensate or incentivize the team to all work together. And so we work through ways to pay bonuses to staff members if the practice achieves certain goals. And there's 100 different ways to set up and structure that. Some owners want a certain dollar amount for the different roles, and some want a big pot to go together, and if there's 5 employees, everyone gets a fifth of it, and it's just a matter of your philosophy and how you want to run your practice. But if you have the ability to set something up that you can help incentivize your team to work together, that little small incentive can pay really big dividends. I think that's the end. And I know that says cardiology on the back there, but I just, one thing we do is help if the IRS does come knocking. As long as you've documented everything and you've got good records, it's not really anything to worry about or be afraid of. Most of the time when our clients get IRS notices, it's because the IRS's computers did something wrong, and we can explain a lot of it away. If you're someone that doesn't keep records and does things that are contrary to what the rules are, then you have something to worry about. But we don't work with those kind of clients. So I brought a giveaway, and I was trying to think of a question to ask. And the only thing that I can really think of is kind of an old cheesy thing that one of my mentors said to me. But the question is, who is your most profitable patient? Does anyone want to take a... That's a good guess. It's not the cheesy answer that I'm looking for here. Yes?
The one in your chair?
Say that again?
The one in your chair?
Yes, that's good too. Anybody else want to... It's not exactly what I'm looking for, though. Does anybody else want to guess before I give it a 50-50 among those two?
I'm going to say what he said. Your own patients? Like, your patients?
You're on the right track. All right, so it all goes back to that overhead. Yeah, I'll throw it back here to you all. But it all goes back to what I was talking about with the overhead. And the answer that I was looking for is the last patient of the day. So if you think about your overhead, you know, the first couple patients that you see, they're covering your rent and your staffing costs and everything. So if you're set up to see 12 patients a day to hit your overhead target, that 13th patient or that 14th patient, a big chunk of the revenue that you're getting from them is all trickling to the bottom line for you. So that's something he always told to me was, the last patient of the day is your most profitable one. So if you can see more, that you're making more money off of those patients later on in a day. I mean, it's just a analogy, but it is true. Does anybody have any?
I have a question.
Yeah.
So just overall, and this is very general, are you finding that your practices that have started to invest in the technology or are all in on technology, are those the ones that are generally producing more? And they're taking over more? Because I know a lot of people, there are still those people say, well, we've not decided whether or not sensors are worth it or whether digital impressions is worth it, and it's a lot of money. But by the time you go out and you're purchasing and you take your Section 179 and you're invigorating your staff because it's something new and different, you're giving the patients what they want, it just puts a different feel in the office, and it really just helps generate that excitement in the production in the office.
Yeah, there's ways that we can look at those things for our clients, and kind of do like a break-even analysis. So, for example, the big thing in the last 10, 15 years seems to be the in-house milling. And so there's ways that we can look at what your lab costs are doing it the way you've been doing it versus what your block cost would be, and how many of those crown procedures you're doing every month, just to kind of see. A lot of people get scared by the $100,000 price tag or whatever, but if you're going to be paying $2,500 a month for 5 years on that loan, but yet you're going to be saving $3,000 a month in lab costs, well, heck, it's a no-brainer to do that, because that's just straight hard numbers. That's not factoring in now that the patient's there one time and not twice. There's ways that we can look at those things to help the dentist make a decision of from a financial standpoint. Now, the technical side's a whole other thing, and I don't wade into that. But I have had clients make the investment, and then it sits and collects dust also. If you're going to do it, I think it makes sense to use it. Otherwise, you're just wasting your money. But yeah, in general, the folks that have the cone beams and are doing the milling in-house, they seem to be doing better because they're able to capture and keep more of that revenue in-house versus outsourcing it to a lab and to other professionals. Yeah.
So when trying to pick a retirement plan for your employees and yourself, I was just doing research, and the one that I found that you can put the maximum back is safe harbor 401k with profit sharing. Is that what you see as a common one that dentists use?
Yeah, typically when a practice starts, so that plan has a decent amount of compliance costs to it, okay? So you've got to weigh those costs against how much you really have available to set aside. So if in your first 1 or 2 or 3 years of practice, it's going to be all you can to put 15 grand aside each year, then there's cheaper things that you can implement, like a simple IRA, that can get you there. And then, maybe after year 2 or 3, you do have the ability to be putting 40 or 50,000 aside every year. Then you would want to hop over to the 401k. It wouldn't make sense to spend a couple grand of compliance costs every year if you're not able to utilize that plan for its maximum benefit. So, established practices, yes, most of them don't want a 401k. Practices 5 years old or less, most of them are still in a simple IRA and working towards maximizing what they can do with that plan, which is free from a compliance cost standpoint. And then if you get up above that level, there's these other more exotic type retirement plans that are called cash balance plans that allow you to stick 6 figures or more in for retirement every year. So that'd be a good problem to have. And we do work with retirement plan folks to help some of our clients that are in that fortunate position to be able to do that. Because if you can set it aside for later and not pay taxes on it now, I mean, that's a better thing to do if you think you'll be in a lower tax bracket down the road than what you're in now.
Then I had a second question. Are most of your clients in a situation where they want you to come in and work just for a certain time period to like resolve something that they find an issue, or you are mostly like a retainer situation where it's a long-term deal between you and your clients?
Yeah, that's a good question. Most of my clients, they pay a monthly fee to our firm, and that depends on what level of service they want from us. So some of them, the bulk of them, someone in the office or the dentist is recording the day-to-day transactions into that accounting software that we talked about. And then our firm will reconcile the account at the end of each month. So we'll get a copy of the bank statement, the credit card statements, and we'll check what was recorded and what happened and talk through those issues. We'll also come up with an annual operating budget for the practice so they have targets to shoot for. And then we will meet periodically, maybe quarterly, to generate those reports and sit down and talk about how this quarter went, what's coming down the road, that kind of thing. And then we'll do the annual tax work for them as well. That's my ideal situation, because that's where I feel like they're getting the most value from what we can do. We have some clients that just do the once a year, they do everything on their own and just bring us their records to do the tax return, but most of them it's a relationship where they can call me at any time and talk through anything that they're going through.
But even still, would you say that the people who want to try to do it all themselves, like if they spend their time actually just going out and producing, they'd probably be better off than they just let you in?
Yeah, I wouldn't exist if that wasn't the case. Like that's definitely that's my selling point really is if I can help you make sense of your numbers better and take some of this off your plate. Number one, hopefully I can give you some ideas that will make you more profitable. And number two, you're going to have more time to actually produce the dollars.
I was piggybacking on his first question. Do you have a lot of like single practitioner practices that offer benefits to their employees, or is it pretty normal for them not to offer medical or anything?
Yeah, no, that's another really good question. Most smaller practices, I would say the majority do not offer health insurance for their staff. It's just really expensive in that 2, 3, 4, 5, 6 employee employer group plan. The premiums are really high. I would say probably like 65% or so of the practices don't offer any health benefits, and the ones that do, they'll pay a percentage of the employee's coverage, and then the employee pays the other chunk of that plus all of their family members if the family members on the plan. So, years and years ago, some practices would pay like 100% of their employees' coverage, but that's almost completely gone away. Most practices On the retirement plan, that is a benefit that most practices offer, and the reason for that is because they're able to take advantage of it also, and that's really the only way that you can get that is if you offer it to your staff as well.
How much, sorry, how much of that comes, like, what does that cost the dentist to offer that to their employees?
What does it cost them?
Yeah, does it cost them anything? I just have
The
always been the
retirement
employee,
plan?
never the employer.
The retirement plan or the
Yes,
health?
for retirement.
Yeah, so there is scenarios where it does not cost the owner anything because none of the employees want to participate. Most of these plans are set up that they're an employer match, meaning the employee has to be choosing to take some of their own pay, stick it into the plan before the employer has to contribute anything. If we just use a hypothetical example of a 3% match. So what that would mean is if I'm an employee and I'm making $40,000 a year at your dental practice, and I don't put anything in, I choose to take all 40,000 of my wages after taxes and keep them, then you as the employer have no cost for that. If I choose to put 1% of my pay, or $400, in, take it out of my paycheck and stick it in my retirement account, you would have to match that 1%, and so it would cost you $400, up to the 3%. So if I chose to do 7% of my salary, you would be stopped at 3%, and so I would cost you $1,200. So 3% of the 40,000 of my wages. So that's typically what most plans end up at is 2, 3, 4% of compensation would be the cost for the employer for offering that for their staff. But it's a way more frequent benefit than the health insurance for one-owner practices that I work with.
Is your practices doing any HSAs?
Yes.
That's the majority?
It's a decent percentage. I don't think, no, it's not the majority. It's getting more common every year. To me, it's a no-brainer to do it. But it does add some level of headache to just one more thing you got to keep up with.
Can't outsource it?
You can, but you've got to make sure they're doing what they're supposed to. Because it's another thing that money has to come out of the employee's check, it has to make it into the employee's HSA account, and if you're choosing to contribute in towards that, it's just another administrative thing to deal with, and some just don't want to fool with that piece. But to me, it's a way better benefit. Yeah, there's a lot of benefits to an HSA. Any other questions? All right, well, I left my cards over here, so if anybody wants to talk or has questions in the future, feel free to reach out to me. I'll probably be pretty busy in the